Best LLC tax strategy in 2024 that your accountant, your tax advisor, or your tax planner is not telling you about. We're going to reveal everything in this video. We're going to talk about how you can use LLC as a different entity for tax purposes. Should you or could you use it as a holding company, or should you be adding your spouse as a partner to minimize the risk of an audit? Everything in this video. Ready? Let's get started. Hey, welcome to my whiteboard tax strategy. My name is Boris Musheyev. I'm a CPA and a certified tax strategist. Every Tuesday, I release a tax strategy video here on YouTube for you, the business owner. By watching this video, my goal is for you to start paying less in taxes right away. So go ahead, subscribe to my channel, like it, share it, and even comment below. I appreciate you. Now let's get started. So, we're going to talk about an LLC, best LLC tax strategies in 2024. I'd like to start off with entity election. So if you have an LLC, which is a limited liability company, by default, you are considered what IRS likes to call a disregarded entity. That means for tax purposes, not legal, but for tax purposes, it considers you as a sole proprietorship. And when you start an LLC and you start having multiple millions of dollars in your revenue or gross revenue or profits, you start paying a lot of taxes on it as a single member LLC because you pay extra 15.3 self-employment income tax. Now, to help you lower that tax burden, IRS came out with something that's called an S-corporation. It's a small business S-corporation, meaning to say you can take any legal entity, such as an LLC or even a C corporation, and elect to be an S-corporation. Now, you're not by default as an S-corporation, okay? You're not by default. A lot of people think, yeah, I'm an LLC, I think I'm an S-corp. No, you have to make that election. Once you become an S-corporation, you're going to start paying yourself a salary, which will help you reduce your payroll taxes on the profit. So LLC is amazing because it has flexibility. Whether you have 2 partners, 3 partners, or just yourself, or you and your spouse, you can make a decision to elect as an S-corporation later on as you start making more revenue, or you start making more profit. Now, what happens is that you have to make an election and file Form 2553. This could be filed by your accountant. You have to do it within 75 days of the year, beginning of the year, or from when you incorporated. But even if you're late, you can do a late S election. Hopefully you are working with a tax advisor who walks you through these steps and letting you know. Once you made an election, you want to put yourself on a salary right away and pay W-2 to yourself as an LLC owner. Now remember, we're also going to talk about when you have LLC as a holding company or adding a spouse. We're going to get there. But right now I'm focusing on the fact if your LLC is your main operating business. Once you've got salary, the first and foremost what you want to do, if you pay health insurance as an owner of your own business, you want to incorporate it into a salary. Why? Because it'll save you not only as a deduction, taxes as a deduction, but also additional savings on payroll taxes. I made a bunch of videos in YouTube about this, so make sure to watch it. We'll also try to put the link for you below. But LLC can be taxed as an S-corporation. That is the takeaway, okay? LLC can be taxed as an S-corporation. What we need to do right now is make an election, pay the salary, and do health insurance. Now, this is going to save you a lot of money on taxes, especially if you're a profitable business owner. We worked with a business owner that was an LLC, didn't know he's not an S-corporation, was paying himself a salary. I was happy he was doing that. We quickly fixed that, made sure the salary is reasonable, added health insurance, and made an S election. He was compliant with the IRS, and he was on his way to save tons of money on taxes. So, strategy number 1, the best one for 2024 is an LLC. And if you're watching this video in the middle of the year or end of the year, you can still make amends, still put yourself on salary, still make a late election, and add health insurance going back to the beginning of the year. You just need to make sure you speak to your tax advisor. Now, let's talk about LLC being a holding company, and we'll do it right after this break. Hey, Boris Musheyev here. Sorry for the quick interruption. 5 seconds, I promise. I want to make sure you get your free PDF, 7 write-offs every S-corporation business owner must know. The link to this free PDF is in the description below. That's it. Thank you so much. Continue watching. Okay, awesome. Welcome back. Let's talk about LLC as a holding company. Now, in many instances, what happens is that a lot of business owners, as they start having profits in the business, they start investing, right? They invest in another business, or they invest in real estate, rental real estates, flips, or it could be commercial properties. And they start questioning, hey, should I be forming a holding company? How should I structure that? So the best practice, first of all, is when you have an LLC, right? I'm going to write over here, a real estate LLC, okay? So when you buy any rental real estate property, we strongly recommend to our clients is to put each property into its own LLC, okay? You're protecting, it's a limited liability company. Let's say you live in Florida, but you bought a property, I don't know, in Georgia. So you might want to open that LLC in the state of Georgia. Okay, now you say, okay, Boris, I've got an LLC in the state of Georgia, but now I want to have a holding company. I've got an LLC in the state of Georgia, instead of Florida, instead of Texas, and now I want to have a holding company. You can certainly do so. You can open up a holding company either in one of the most favorable states when it comes to opening up holding companies. This could be Nevada, Wyoming, or Delaware. You know, definitely speak to your attorney about this. Okay, definitely speak to your attorney about this for legal protection. But you can open up a holding company in one of these states. Then this holding company is in fact going to own each individual LLC in which the properties are located. Now, again, we're assuming that you already have a main business LLC as an S corporation, and you converted that to an S corporation. You're on your way to save money on taxes. Now you start investing more, and you start putting each real estate, or you could own other businesses, right? You could own a share in another business. You could be a partner in another business where you're receiving residual income, or you're a passive partner. So this could also be an LLC. Okay, and then you can have a holding company in one of these states, speak to your attorney, that could own these LLCs. That is another strategy that LLC can be used for. Remember, LLC is flexibility. That's what I like to say. It's so flexible. It could be used for your main operating business. It could be used for your real estate holdings, or it could be used as your holding company. Now that you've got your main business, LLC, structured as an S corporation, you've got your holding company, and you've got real estate, let's talk about, should you be adding your spouse as a partner to your LLC to minimize the risk of an audit? And we'll do it right after this break. Hey, thank you so much for watching the video. Very quickly, if you don't mind, I want to ask for your help. I need your help. I want other business owners just like you that will benefit from a video like this to catch this video. The best thing that you can do for me, please either like the video or even say something in the comments, because that really helps the YouTube algorithm when it sees a lot of engagement to push the video to other business owners just like yourself, or better yet, subscribe to the channel would be much appreciated. Thank you again. Now let's get back to the tax strategy. Welcome back to this video. Let's talk about adding your spouse. Now you're like, Boris, what do you mean adding my spouse? To my S corporation, to my holding company, or what? So a lot of times what happens is that business owners that I work with that are very profitable, and we, thank God, help them save a lot of money on taxes, okay? They start another business. Now, when they start another business, they ask him, Boris, should it be another S corporation? And the answer is really always depends. In some cases, it cannot be an S corporation for whatever other reasons, right? I'm not going to get into details, but it needs to stay as an LLC. And it's an operating business that the client is involved, or you as a business owner could be involved in. It generates revenue, it generates expense, it has expenses, it generates nice profit. Now, if you file, remember what I said, LLC is a disregarded entity. For IRS purposes, it is treated as a sole proprietorship, as a Schedule C. So that means you have to add it on your Schedule C. Schedule Cs in America have the highest audit rate. I believe, if I'm not mistaken, the last census that was taken, the last report, excuse me, that came out, I believe it was about 8 or 9% audit rate for Schedule Cs. So when you put your business on a Schedule C, your LLC as a sole proprietor, IRS says, whoa, $1.2 million in gross revenue, $700,000 in expenses, and we see no balance sheet. because there is no balance sheet with Schedule C, bam, that return has a higher probability of getting picked up for an audit. What we do with our clients, we're like, hey, how about we add your spouse as a partner? Now, some clients are very comfortable and say, you know what, my spouse can be 50%, or some clients say, oh, I don't want my spouse anywhere near that. So we just give her 0.01% or 1%, whatever your financial situation is with your spouse. But why do we want to do that? Is because we're triggering what's called a partnership tax return, right? Form 1065. That means we're now not going to be filing a Schedule C, but we're going to file a partnership return. And guess which has the lowest audit rate? Partnership tax returns, okay? So they have the lowest audit rates, and bam, we just decreased the audit rate from like 8% to like almost nothing, right? So now we continue reporting that same income. Now, I'm not trying to over here to say, hey, avoid IRS. What we're trying to do is minimize the risk of audit. Now, if you do get audited, you should not be afraid of the IRS, especially if you've done everything diligently and correctly, and you have documentation for all of your expenses and your income. It's just that we want to avoid a headache of dealing with the IRS and the audits just because we didn't know this little thing that your tax advisor could have told you. Now, you're like, Boris, how can I add my spouse? You might want to call your attorney, your corporate attorney, whoever put together your corporate paperwork, and add your spouse to your operating agreement. Transfer the ownership. There will be no taxes on the transfer of ownership to your spouse, so you're totally okay there. Hope this was helpful. Ladies and gentlemen, if you're not working with a tax advisor yet, please get yourself a tax advisor, especially if you're opening up new entities, new LLCs, you're thinking about doing holding companies, real estate, adding your spouse as an owner, having LLCs and S-corporation. All of this requires tax planning. Your tax preparer that puts the right numbers in the right boxes is not going to be doing that for you. Thank you so much for watching this video. Until the next time.